Good morning, ladies and gentlemen. Welcome to the ESKEN Limited full-year results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, type in your question, and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified by email once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David Shearer, Executive Chairman, and Lewis Girdwood, CFO of ESKEN Limited. Good morning.
Good morning. Welcome to the presentation of our full year results for the year to February 28th, 2021. Within this presentation, we will lay out how, despite the unprecedented challenges experienced during the year, we intend to secure the financing required to support our recovery in a post-COVID world. Looking at the agenda, we will cover the progress made during the year, the challenges we experienced and the actions we took, the impact of Stobarteo's liquidation, the funding we have secured, our financial performance, and our strategy for returning value to shareholders over the coming years. Let's look at the key milestones of the last year.
The impact of the pandemic has been significant on people, society, and the economy, and the ramifications are likely to continue for some period of time. The pandemic has lasted far longer than most of us envisaged this time last year. However, tight cash management since the onset of the pandemic allowed us to respond to these challenges and ensure that the group had the resources to manage through the crisis and maintain the operational capability of our core businesses. As a result, we now have an energy business that is returning to pre-COVID performance levels, and critically, we are concluding a long-term strategic partnership with Carlyle to support the development of our London airport, London Southend Airport. Sadly, ESKEN exhausted all options to find a buyer for Stobarteo that was in a position to transact, and as a result, we withdrew funding and the board of Stobarteo has placed the company into liquidation. We continue to have a number of liabilities attached to Stobarteo that we need to fund through to mid-2023. In order to manage these liabilities, in addition to the £120 million of funding we are securing through the Carlyle deal, we have also accelerated a £60 million refinancing comprising around £40 million of equity on a documented prospectus issue and a £20 million standby revolving credit facility to meet our normal treasury needs.
This funding package, when completed, will allow us to pay down the existing bank debt, underpin the business plan, and meet certain of our legacy obligations. Importantly, it will allow management to focus all efforts on the core businesses as they recover from the pandemic and deliver value for shareholders. Let me touch on the progress since the capital raise in 2020. The journey, as you'd expect in a year like no other, a lot has happened, and we have had to take a number of decisive actions. We announced a successful capital raise of £100 million, together with additional bank facilities of £40 million in June 2020. This allowed us to maintain the operational integrity of our businesses through this period of significantly reduced demand. At the time of that capital raise, we announced our intention to focus on two core businesses, energy and aviation, with the stated intention of exiting the other businesses. To that end, we announced the sale of the rail and civils business to Bavaria Industries Group in July 2020. As mentioned already, the sale of Stobarteo fell through and that business entered liquidation. We will cover this in more detail later in the presentation, as well as the new funding solutions which we have announced today. Let me just highlight some of the actions we took to manage specific challenges impacting our operation. Aviation has been particularly affected by COVID-19, with passenger numbers at London Southend falling by 93% year on year, following restrictions on air travel and airlines reducing the number of flights at both our airport and across the air travel sector. In addition, EasyJet announced it was closing its London Southend base from 31st August 2020. In response, we minimised cash burn, made significant use of the furlough scheme, and leveraged uninterrupted logistics operation on the north side of the airport. Whilst on face value the energy division appears less exposed to COVID-19 given the nature of its operation, it did face two key challenges. The first was the closure of the construction industry and recycling centres nationwide for a 3-month period in lockdown 1. This created a supply shortage at a time when we would typically look to build stock for the winter demand. In turn, this drove the second key challenge, which was the weakness in gate fee revenues as wood supply came back online following the return of construction. Stobart Energy took the decision to accept lower gate fee income and also import waste wood from Europe. Doing so put pressures on our margins, but ensured we maintained our supply contracts and supported our customers, positioning us well going forward. The business performance is now returning to pre-COVID-19 levels, where we were reporting EBITDA of circa £50 million. Let me just touch on ESG. During the year, we also made progress on our ESG journey. We also acknowledge that we have a long way to go. We have produced a stakeholder-led framework on which we have developed our 5 ESG pillars. We've established an internal steering group with executive sponsorship to drive through progress against our development plans, and also intend to create a board-level sustainability committee later this year. The first stage has been to collect both social impact and environmental data to inform our future plans and KPIs. We are developing our diversity strategy and have reported on our gender pay gap. We continue to support the skills development of our people through apprenticeships in multiple disciplines across all levels, and believe that this will be critical as the country faces challenges in the labour market. During this very difficult year, our people have still wanted to give back to local communities. We have raised money for multiple charities through various fundraising activities across all our business divisions. Health and well-being and safety and security have been a focus on producing a COVID-safe working environment. All our measures and procedures have been developed in line with government guidelines, which made it possible for colleagues to return to our offices and operations safely. We are acutely aware of the impact of COVID on mental health and are monitoring the situation closely. We are committed to minimising our environmental footprint and have established our priority areas on carbon, energy, wastewater and air quality. We have reported our Scope 1 and 2 emissions and are developing our reporting to include Scope 3. This is an area where I look forward to reporting on more progress next year as we further implement our ambitions and strategy. I'm now going to hand over to my CFO, Lewis Girdwood, to explain the funding plans and financial results for the year. Lewis.
Thank you, David, and thank you for joining us today. I'm going to start by providing an overview of Stobart Air and our funding plans. As we entered the year, we were already aware of the growing threat from the pandemic and the impact that it was likely to have on the business. An early casualty was the failure of Connect Airways in early March 2020, due to its inability to access additional financing, given the collapse in demand for air travel. This led to a decision by the board to reacquire Stobart Air and Proprius, the related aircraft leasing company, from the administrator of Connect. This allowed us to take control of legacy liabilities, which would otherwise have had a significant and immediate impact on the group had Stobart Air failed at that point. We immediately embarked on a process to find a buyer for Stobart Air, with the objective being to mitigate the residual liabilities attaching to the group. This process was affected by the extended lockdown in travel between the UK and Ireland, and the decision by Aer Lingus in November 2020 to award preferred bidder status in relation to the franchise renewal from January 2023 to another party. While we announced an agreement to sell the business to Ettal in April 2021, the continuing uncertainties around travel and issues with the prospective purchaser's funding package led the board to conclude it was not possible to complete the transaction. Ettal's inability to secure a funding package meant we had to take a decision on Stobart Air, and we notified their board that we were no longer prepared to continue to provide funding to the airline. This led the board of Stobart Air to terminate the franchise with Aer Lingus, cease to trade and appoint a liquidator. While this was not the outcome which the board had hoped to achieve, it was just not possible, despite the exhaustive attempts of the respective management teams to save the business. The group has retained responsibility for the 8 ATR aircraft, which were subject of a pre-existing guarantee until the expiry of the leases until April 2023. And we are actively working to sublease the aircraft to other operators to minimise the impact on the group. Although the group retains certain liabilities through the period, these are now clear as to quantum and timing, and the lease term and associated cost is less than could have been had the airline not been reacquired by ESKEN in April 2020 and failed then. In order to realise the full value potential of LSA, we have today re-emphasised we expect to enter into a funding arrangement with Carlyle Global Infrastructure Opportunity Fund as a long-term strategic financial partner for the development of the airport. Carlyle is a major global funds business with $260 billion under management and has concluded 70 airport transactions around the globe. Once agreed, Carlyle would provide funding of £120 million net of costs by way of a secured loan with an option to convert into just under 30% of the equity in the airport. This implies a valuation of the airport of £400 million. This funding, £100 million, is released to the group to refinance the bank debt drawn on facilities, which expire in January 2022. The remaining £20 million is retained within the LSA business to meet its funding requirements over the next 3 years. It is expected that after that time, the airport will be able to support its own third-party debt funding for further development. It is intended that future CapEx funding of LSA will be arranged on a standalone basis as demand recovers. The combination of the proven operational capability of the LSA management, along with the airport development experience of Carlyle and its financial muscle, will provide a strong partnership as we rebuild our commercial relationships with our airline and other partners into the recovery. We have also announced a new proposed funding package of £60 million gross. This will be made of a documented equity issue of around £40 million and a new standby RCF bank facility of £20 million. These are the final elements to refinance fully the existing bank debt, meet certain of the legacy obligations, and provide the necessary working capital to underpin the group's business plan as we emerge from the pandemic. We will also actively work to realise the residual infrastructure assets with a net book value of £39 million at the year end to provide additional resources for investment. Moving to the financial performance, group revenue is £110.7 million, which is a 22% decrease on last year as operations were interrupted by the impacts of the COVID-19 pandemic. EBITDA is a £17.9 million loss, an increase from a £6.2 million loss last year. We will take a look at the divisional EBITDA results on the next slide and talk about the makeup of that loss. Loss before tax of £150.3 million is largely made up of non-cash items. Net debt, excluding IFRS 16, is £127.4 million, as the headroom created by the capital raise was used to fund Stobart Air and Proprius, as well as supporting the continued core operation. Headroom of £77.4 million represents cash of £12.4 million and £65 million of undrawn facilities on the RCF. Next, we'll take a look at the divisional performance of revenue and EBITDA. These results are from continuing operations, so do not include the Stobart Rail and Civils business that was disposed of in July 2020. Also, a reminder that we're reporting EBITDA as opposed to underlying EBITDA as we continue to make the business easier to understand and report on. Overall revenue has decreased from £142.1 million to £110.7 million, and EBITDA increased from a £6.2 million loss to a £17.9 million loss. In what has been a challenging year due to the coronavirus pandemic, aviation revenue has been impacted by the passengers at LSA dropping from 2.1 million to 0.1 million. But this resulted in a drop of 56.4% of revenue as the global logistics business and summer flying was able to reduce the impact. Energy revenue and tonnes supplied are broadly in line with last year as tonnages fell by only 0.1 million to 1.4 million. Investments include Stobart Air and Proprius in 2021, which were reacquired in the early part of this year. Group central revenue has reduced due to royalty income ceasing upon disposal of the brands at the beginning of FY21. Aviation EBITDA was less impacted than revenue due to a combination of strict financial discipline, reduced airline marketing contributions, and continued logistics income. Despite aviation seeing a £32.1 million loss in revenue against FY20, the overall loss at EBITDA was an increase of £5.4 million, reflecting the strict financial discipline and maintaining the global logistics business throughout the pandemic. However, energy EBITDA was impacted by abnormal supply and demand following the closure of the construction industry and household recycling centres, which led to weakness in gate fee revenue during what is normally the highest point in the seasonality. This affected gate fees as demand outstripped supply and actions were taken to protect supply of wood to our main plant contracts, including the use of imports from overseas. Within investments, although the loss from Connect Airways in 2020 hasn't been replicated this year, the net loss from Stobart Air and Proprius in 2021 is £1.4 million higher than Connect was last year. The impact of the reduced revenue and group central costs has been partly offset at EBITDA level by strict financial discipline applied across the group during these challenging times, and we have demonstrated strong cash management within the core businesses. Starting with the EBITDA loss of £6.2 million from the previous slide, we can see that without Stobart Air, EBITDA improved by 128% to a £1.7 million profit. The improvement in investments as a result of the profit from Proprius and no share of losses from Connect Airways this year outweighs the decrease in aviation and energy. This bridge shows the movement from EBITDA, excluding Stobart Air, of £1.7 million from the previous slide, to loss for the year of £155.1 million and has been colour-coded to allow focus on the cash and non-cash items. Depreciation has increased this year due to the inclusion of aircraft in Proprius. The cash finance cost of £8.7 million is interest payable on leases and debt. Non-cash items totalling £3.7 million are the release of debt issue costs of £2 million, interest accruals of £0.8 million, and foreign exchange losses of £0.9 million. Other significant non-cash items are the loss on acquisition of Proprius of £16.9 million and impairments, which are Proprius aircraft of £11.5 million and loan notes in the biomass plant part ownership of £8 million. Loss before tax, excluding Stobart Air, is £70.5 million compared to a loss of £139.4 million last year. Tax is a £7.1 million credit, mainly due to deferred tax assets not being recognised in respect of certain temporary differences. Including Stobart Air and the Stobart Rail and Civils discontinued businesses, the total loss for the period is £155.1 million. This chart shows the movement in cash in the year. We successfully generated net proceeds of £91 million from the equity raise in June 2020, which was mainly used to repay the RCF and reduce the bank facility. This created headroom, which was subsequently used to fund Stobart Air and Proprius. Cash proceeds of £8.5 million were received from the sale of Stobart Brands to Logistics Development Group. The remaining £1.5 million of this transaction will be received within the 3 years of the sale. £5.2 million of cash was generated from our continuing operations, excluding Stobart Air. Repayment of debt, including interest, totaled £57.5 million and includes RCF repayments and lease repayments on property, equipment and aircraft leases. Purchase of tangible assets of £3.1 million was mainly spent at London Southend Airport. After other smaller movements totalling £1.6 million and before the impact of Stobart Air and Stobart Rail, the cash balance is £55.7 million. Including Stobart Air and Stobart Rail, the final cash balance at year end was £12.4 million. Next, we have the balance sheet, where overall net assets have reduced by £54.8 million in the year to £48.3 million as a result of the increased liabilities following the acquisition of Stobart Air and Proprius. Net assets of £8.9 million were disposed of with Stobart Rail, which were mainly tangible assets, current assets and other liabilities. Loans and borrowings have reduced as the RCF was paid down following the capital raise. Some of the headroom this created was later utilised to fund Stobart Air and Proprius. IFRS 16 lease liabilities increased following the reacquisition of Proprius, which accounts for £35.7 million of the balance at February 2021. Gearing, excluding the impact of IFRS 16, has reduced from 147.1% to 121.4%, as the repayment of debt outweighed the decrease in net assets. With IFRS 16 included, gearing increased from 228.4% to 519.2%, as significant IFRS 16 lease liabilities were brought on balance sheet with Proprius. Here we can see the movement in net debt with Proprius, Stobart Air and Stobart Rail shown separately. Proprius is shown separately here to highlight the significant impact this business had on net debt. The most significant movement is the cash generated from the capital raise in June 2020. The cash used in continuing operations, excluding Proprius and Stobart Air, is £4.8 million. Interest of £8.7 million was paid, which mainly relates to leases and the RCF, and a £4.5 million loan related to Connect Airways was repaid. Including the other smaller movements, the net debt before Proprius, Stobart Air and Stobart Rail is £163.6 million. The Proprius and Stobart Air movements relate to IFRS 16 debt and cash spent including funding. Closing net debt at February 2021 is £250.8 million, which is an overall increase of £15.3 million. Let me hand you back to David, our Executive Chairman, to talk you through our strategy. Thank you.
Thank you, Lewis. When the facts change, I change my mind. A shareholder sent me this quote a little while back, and I think it's a really useful one. We all need to adapt as circumstances change, and that has certainly been the case for Reskin. The impact of the pandemic has been both greater and over a longer period than anticipated last June at the time of the capital raise. This has led the board to undertake a refresh of the strategy and consider the funding requirement for the group. We have concluded that the group owns two attractive businesses which can generate significant value for shareholders as markets recover post-COVID-19. The key strategic objective will be to drive shareholder value from these core assets over the medium term. It was intended at the time of the capital raise to seek to monetize the energy business within an 18 to 24-month period. However, the board has concluded that this is not the right answer from a shareholder value perspective, and instead we will benefit from its cash generation while the airport recovers from the effects of the pandemic.
Prior to the pandemic, London Southend Airport offered passenger services to over 40 destinations to a market of around 8 million people living within 1 hour travel time of the airport. Whilst aviation has been one of the hardest hit sectors by the pandemic, the fundamental long-term value drivers of the airport remain sound. This has been recognised through the strategic partnership agreement we are concluding with Carlyle.
The travel sectors in which London Southend operates are those expected to return to 2019 levels the fastest: short haul, leisure, and people visiting friends and relatives. Only 15% of London Southend Airport's travel was business related in 2019. The London market has historically shown resilience to previous falls in global demand, with quick recovery and a growth trajectory which is above UK GDP. London will again become a capacity-constrained market as demand begins to recover from 2022 onward. Low-cost airlines are expected to be at the forefront of this, and these airlines will all be aiming for market share growth. This will require slot growth across the London airports. This puts London Southend in a strong position in the coming years, with low-cost airlines and network carriers relocating traffic and likely to be seeking available runway slots at the right price and with the right service levels to aid the recovery. The rate of growth is still undetermined as the market recovers from the COVID-19 pandemic. However, there is a good opportunity for the airport to recover faster than some of its counterparts who focus on network carriers and long-haul traffic. The rail connectivity direct to London Liverpool Street Station will continue to be an advantage to the airport and will play an important part of the attractiveness to both airlines and customers. ESKEN will continue to invest in the infrastructure of the airport in step with passenger demand recovery, allowing London Southend to meet the needs of airline partners for an efficient, cost-effective London airport while offering a safe and enjoyable passenger experience. In addition, there is an opportunity to develop the logistics offering, both with our existing global logistics partner and other related businesses. Given the award of the Thames Freeport status in the estuary and proximity to East London, the airport is well placed to capitalise on accelerated air freight growth and movements. This development will include putting in place ancillary support infrastructure to attract further long-term partners providing additional revenue. Stobart Energy is a recovering cash-generative business with a strong market position and long-term supply contracts. It offers the opportunity to generate returns from an infrastructure-type asset with an environmental benefit in recycling waste wood to produce energy rather than going to landfill. Over the next 12 to 24 months, we expect our customer plants to enter the next stages of plant performance optimization. This should benefit Stobart Energy through increasing reliability and throughput volumes. The continued focus on strong customer management and collaboration is a complementary focus for us and will assist our supply chain optimization strategy. Assuming a continued national COVID-19 recovery over the next 12 months, we expect to see the recovery of our supply margins and EBITDA performance and return to pre-COVID levels where we last reported £50 million EBITDA. Opportunities are also being explored to seek additional supply contracts, and we will look to broaden the base of the market offering within the energy from waste space where existing operational expertise can be applied over the medium term.
As a result of the funding package that we are announcing today, management can, for the first time in a long time, look forward with a clear focus on optimising our two growth assets. Energy is returning to pre-COVID levels of operation, while the airport's development will be underpinned by our partnership with Carlisle.
We have exited Stobart Rail and Civils, and Stobart Air have a clear picture of our ongoing legacy obligations and have secured the funding to meet these obligations and our working capital needs. With that done, we can now get on with the important job of optimising the profitability of London Southend and Stobart Energy and delivering shareholder value. Ladies and gentlemen, thank you, and we'll now take questions.
Thank you very much, David. Thank you very much, Lewis. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those investor questions, excuse me, submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the team can better understand your views and expectations. Lewis, David, perhaps if I could just ask you just to bring your camera back up, that would be fantastic. Thank you. That's great. We've just got you up there, and we'll leave the floor open for a little while just to see if we get some questions pulled through from the attendees. Thank you. If I could, where appropriate to do so, ask you just to read out the question and give your response where appropriate, that'd be fantastic. Thank you.
I think there's a couple of questions there about the terms of the timing of the new equity raise. That'll be announced at the time of launch at the end of, which we plan to be at the end of July, by the end of July. Do you want to
Okay. Yeah, let me touch on. Ross H has asked about the passenger traffic outlook for LSA, both this summer and for winter. Now, clearly, we don't tend to comment too much from an outlook point of view, given the uncertain times that aviation has at the moment. But clearly, as you can see, aviation is impacted depending on what the green routes are, and the take up for that is obviously high when it comes through. So at the moment, we've been very cautious in our views around summer. We have always said in all our discussions that we felt that it was unlikely to see a summer for FY22, and that we would be more likely to see it recover next summer in FY23, and that certainly would still be our perspective, that it is still a very uncertain period for aviation, both at airport and at airline level.
I think there's still a question there sitting about whether the equity capital raise included an open offer from Edward R. I answered that in my previous answer, that we will disclose the structure and the basis of the offering once we have taken our market soundings and are launching.
Thank you, David. Lewis, unless there's any further questions that do come through, I think that will conclude the questions we have received from investors. And of course, if we do get any further questions through, you will be able to review those as you see fit.
There's some coming up there. Yeah. Do you want to
let me do. So Andy M's just asking, having repositioned the business, can you expand on how you see the partnership with Carlisle expanding at LSA? I think it's clearly obviously early stages in terms of the relationship and the partnership that we see there, but these are very, very experienced investors in the airport infrastructure around the world, and we think that with the management experience that we've got at the airport, and alongside that experience that Carlisle bring, that should help us develop and think carefully about how we pull LSA London Southend forward in the future. So it's early days, but I think that what we've seen is that we are very like-minded in our approach and the way that we would invest in the airport.
I think it's also a good thing to have a positive endorsement from a very experienced global investor in aviation and airports who've looked at the opportunity at London Southend and believe in it. So we look forward to working with them as a partner once we conclude the deal.
You want to do the Brian M?
Yeah, Brian M asked if we've changed our position on Stobart Energy, where previously we were going to monetize. Do we see it as a cash generator for the wider business? At the time we did the capital raise last year, we expressed that business. They have worked to reposition it, and we have now decided that actually it's in shareholders' interest for us to retain the business and develop it and grow it for future value.
Okay, and then Paul C has asked what options are there for Carlisle Airport. Clearly, we are looking at options there following the attempted sale of that, but it is early days, and we will continue to look at monetizing our non-core infrastructure assets as we've indicated.
Do you want
to that?
Yeah. Rob B just asking, the going concern statement say that all three financing events need to happen or when will happen. Wondering about the sequencing. They're all interconditional. We will launch the equity raise by the end of July. It will go to a shareholder vote probably around mid-August. That shareholder vote will also cover the proposed Carlisle deal, and on the basis that shareholder vote goes through, and we've got strong support from our major shareholder on both those counts, then everything will happen at the same time by the end of August.
David Lewis, I think that concludes the questions that we've had through, and you have picked up on those where you can. And as I said earlier, anything further that comes through, of course, the team will be able to review those. On that basis, David, may I perhaps just ask you for a few final words just to wrap up before we redirect investors to give you some feedback, please?
Sure. I think the important thing is, obviously, for everyone and everyone on this call, it's been quite an incredible year. It's probably been the most challenging year for society, for the people in it, for every business, and particularly business in the aviation sector. So it's good to have got to this point. It's good to be securing the financing to underpin the business going forward at a point when we already see recovery coming through in the energy business, and we expect that to be at pre-COVID levels for the end of this year. And then we're in a position to work with a new partner to recover the aviation business at London Southend, and what undoubtedly, at the end of the day, people will start to travel as soon as they can, as soon as there is clarity and consistency, and they don't have to incur significant costs on testing. The British public, at the end of the day, like their holidays in the sun, and will do that at the first opportunity when they've got some certainty. So thank you, everyone.
That's fantastic. Thank you very much, David. Thank you, Lewis, for updating investors today. Can I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and be greatly valued by the company. On behalf of the management team of ESKEN Limited, we'd like to thank you for attending today's presentation. That now concludes today's session.